as was said before, the book of economist jokes and humor is very, very thin, so I think we ran out of those jokes, and I'll spare you any more of it. They were already, most of them used by Dr. Levine. What I'll do instead is try to give you a little bit of my outlook about the U.S. and the global economy. But before I do that, actually, sometimes people come and ask me, how come you got it right when most people, economists or otherwise, it was not just economists, policymakers, Wall Street, bankers, rating agencies, almost no one got it right. I'm not sure what was it. Some people will say I just got lucky, but I think that that relates to my kind of Jewish background. Is that I think I've been raised like all of us in terms of thinking, in terms of critical thinking, lateral thinking, contrarian. As Jews we're often outsiders in communities we go. I was born in Turkey, then moved to Iran, Israel, and then into Italy, and eventually came to the US for grad school. So that openness to the world, to critical thinking, I think is the most important thing. So usually people think about the wisdom of the crowds. Unfortunately, this time around, instead of the wisdom of the crowd, we had the madness of the crowds. Group thinking led to failing to understand and realize the severe vulnerabilities we're facing. So if I have to give kind of a piece of advice to these very, very bright young men and women who are majoring in economics, is just keep that critical thinking. It's going to be very important in every aspect of life, and I think that's part of Jewish education and tradition all the time. So that's what's important to think in that way. So what is the outlook now for the US and the global economy? I think there are about 5 or 6 questions that are on everybody's mind, whether you're a business person, an investor, an asset manager, a student, a scholar, and policymaker. And trying to give answers to this question is going to be crucially important. Of course, we live in a world of uncertainty. We don't know what things are going to happen, how things are going to evolve. And I think that's one of the critical things we have to keep in mind. No one has the monopoly on wisdom, and therefore the future is as uncertain as the past. But at least we have to ask what are the important questions, and based on those, try to give some sense and the answers to them. That's going to help us to guide also the right policies. The first question on everybody's mind is about this severe financial crisis. Everybody agrees at this point this is the worst since the Great Depression. I'm going to spare you today a discussion of what were the causes of this crisis. I think the crucial question looking ahead is the worst behind us? Is the worst ahead of us? How severe are the problems of US financial institutions? Are some banks insolvent? Will the program of the government work? How much the losses are going to be? What will be the result of the stress test? How should we deal with these problems? So that's first an important question. The second question is the outlook for the US economy. We are in the middle of a severe recession, there is no doubt about that. But there is a debate on whether this is going to end soon. There are some people who are bullish and optimistic, say we see green shoots of spring, we see second derivatives of economic activity now becoming positives. We're seeing glimmers of hope, and then they say we're going to recover to positive growth already in the second half of this year. I'm much more skeptical and bearish. I'll try to explain why it's going to be much more severe and protracted. Third question is the question of the rest of the world. What's happened to the rest of the world, because it's a global recession at this point. Last year the theory was one of decoupling. People believed that in spite of the US having a severe economic contraction, the rest of the world would decouple from this US contraction. Instead of decoupling, we had massive recoupling, first of financial markets and then of the real economy. Usually people say when the US sneezes, the rest of the world catches the cold. This time around, the US was not just sneezing, had a severe case of chronic pneumonia, and first the financial contagion, the real contagion, affected many in different countries. Now we're in a global recession. How severe, how long, how protracted, who's going to get out of it first? Europe, Japan, China, other emerging markets. The fourth question is the one about whether we should worry about deflation, falling prices, or about inflation, and over which horizon we should worry about inflation versus deflation. It's key to understand what's going to happen to government bond yields and many other things. The fifth question is what are the appropriate sets of policies that are going to get us out of this economic and financial crisis, monetary and fiscal policy, traditional and non-traditional monetary and fiscal policy, and other policies. Policies to clean up the financial system, policy to deal with the unsustainable debt burden of households that are buried under a mountain of mortgage debt, credit cards, auto loans, and student loans. Policies to restore credit creation, given there has been a severe problem in the financial market. Policies to help through IMF money and otherwise emerging markets in trouble. And other policies to provide regulatory forbearance so that we have a restoration of credit. So it's not just monetary and fiscal policy, there are about 6 or 7 different dimensions of policy, and different countries are doing different things in the US, in Europe, in emerging markets. And the final question, that is the one more relevant for investors, is what are the implications of all this for all the major asset classes, US and global equity? For example, for the last 7 weeks since the lows of early March, we've seen a rally in the stock market, up about 25%. Is this a really recovery of a bullish stock market, or is another bear market rally, what people refer to as a dead cat's bounce? There are different opinions. I'm bearish. I'll explain why. What's going to happen to government bond yields in the US and abroad? What's going to happen to corporate spreads, to the value of the dollar relative to major currencies, to commodity prices, oil, energy, food, minerals, gold? What's going to be the outlook for housing and housing-related assets in the US and other countries? And what's going to be the outlook for all of the emerging markets asset classes? Now, of course, I don't have time to dwell in each one of these different asset classes. If you want to know my views as on gold prices, I'll be happy to do so in the Q&A. But I'll try at least to give you a brief answer to this kind of 6 questions, or what are my views in this world of uncertainty. On the first question about the financial crisis, I would say there are some good news and there are some bad news. The good news is that last fall we were literally on the verge, 1 epsilon away from a global financial meltdown after the collapse of Lehman. Literally, it was like a cardiac arrest of the global financial system for several weeks in September, October. Compared to that condition, things have improved meaningfully. Why? Because the advanced economies, the G7, around November at the IMF meetings, they said a few things were important. They said, we're not going to let anybody else who is systemically important to collapse in a disorderly way, i.e. we made a mistake letting go of Lehman the way we did. We're going to provide unlimited liquidity to financial institutions to reduce these money market spreads and the liquidity crunch. We're going to recapitalize financial institutions as needed. We're going to guarantee more widely deposits, and we're going to also guarantee a wide range of new and old debts of financial institutions. We're going to do everything else that is necessary to avoid a systemic meltdown. So that's the good news. The condition of financial market today, money markets, even credit markets, have somehow improved compared to 6 months ago. That's where the good news ends, because in some sense, the problem of the banks and the financial institutions, in my view, are as severe today as they were before. And I want to give you a sense of it. You know, about a year ago, I wrote a piece in which I estimated that expected losses on loans and securities issued by U.S. financial institutions could be at least $1 trillion, and more likely as high as $2 trillion. And about 3 months ago, I updated these estimates to an even larger number, $3.6 trillion. Now, at that time, a year ago, people were skeptical of even the $1 trillion number, because they had in the back of their mind about $200 to $300 billion of subprime mortgage-related losses. You know, what I pointed out, however, was that this was not just a subprime mortgage problem, with a much more generalized housing and asset bubble and credit bubble. And once the economy would tip into a recession, US and globally, those losses would spread from subprime to near prime to prime mortgages, to home equity loan lines, to commercial real estate, to credit cards, to auto loans, to student loans, to leverage loans that finance LBOs that they should have never occurred, to industrial and commercial loans, to corporate bonds, and then to the entire slew of assets that securitizes underlying loans, CDOs, CLOs, CMOs, the entire alphabet soup of credit derivatives. You know, guess what? In a matter of months, the IMF came with an estimate of $1 trillion, then $1.4 trillion, then 2.2, and this past week they've come with an estimate of 2.7 for the US and 4.1 globally, meaning 1.4 of the losses will be for European, Asian financial institutions. So the 2.7 number is very close to my 3.6. We use similar methodology, but I try to estimate what peak losses are going to be as opposed to what are current default rates and so on. That's the main reason why the numbers are kind of smaller for them. Now, out of that 3.6, half of it is US banks and broker-dealer, 1.8. Their capital last fall was about 1.4. So even if you account for provisioning and for recapitalization by the government and the private sector, the overall capital of the financial system looks like close to zero, meaning in the aggregate, looks like most of the system in the aggregate is insolvent. Of course, that doesn't mean that every bank is insolvent, and it's true that time can heal many wounds. If you let banks essentially have forbearance, if you let them borrow at zero interest rates or in guaranteed way, they earn a nice spread between their lending and their zero borrowing rate, and they can rebuild capital through these earnings before provisions. But in spite of that, there may be some institutions that are so much beyond pale that even time is not going to be able to heal their wounds. And because of that, I've argued something controversial, it's an open policy debate, that in order to avoid ending up like Japan, with zombie banks are kept alive, the right thing to do would be a temporary takeover of those financial institutions that are deemed to be kind of insolvent. So we do what Sweden did. Nobody's, of course, in favor of a long-term ownership of banks and financial institutions by the government, but the temporary takeover, clean up, and then sell it back to the private sector might be a better idea than keeping zombie banks alive and having a credit crunch that lasts for a decade, like Japan, with economic contraction, stagnation, deflation, and so on. But that's an open question. Certainly, this is not the view of the administration. They prefer this approach of muddle through, and we'll see the consequences of that. I could say certainly much more on it, but maybe some of the detailed questions are going to come up in the Q&A. Second question, the outlook for the U.S. economy. We are in a severe recession, and last year the debate was between those that were the majority and the consensus that argued that this is going to be a V-shaped recession, contraction and then rapid recovery, lasting about 8 months, like the last two recessions, 1991 and 2001. And those like myself who said, no, this is going to be much more long, ugly, protracted because of the financial imbalances of firms, households, financial institutions, the lack of savings of the households, for example, overconsumption, overspending. And I argued that instead this recession will be more like U-shaped, lasting more like 24 months. I also argued there was some small probability, however low, that we end up like Japan in an L-shaped stagnation,